Thank you for joining us this afternoon. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital, and I'm very excited to be joined by Christine Mastrandea, the President and Chief Operating Officer of Whitestone REIT. Very timely, since Whitestone announced a big acquisition in my backyard here, or kind of my backyard in Fort Worth, Texas yesterday, that we could kind of use as maybe as a walking case study as we go through this presentation today of how Hewlin could potentially play into a lot of these things that we're going to discuss. From a very high level, as we get into this here, for those that don't know, Whitestone owns shopping centers in a handful of markets that we know very well: Phoenix, Austin, Dallas, Fort Worth, Houston, San Antonio. They have a variety of service-oriented tenants, food, health and fitness, services. I think a key takeaway here is that a lot of the tenants, you can't necessarily replicate it from an online presence, as in you can't go pick up the food necessarily by an Uber Eats, which you could order online, but that which you can't replicate online is what you would find at some of their shopping centers. They have deep local connections with their communities that they operate in. And so they're basically able to respond to the communities in their backyard by bringing out the right tenant mix. And I want to get into that because I've had some more questions that have popped in my head, kind of playing into that, called that sweet sauce of a tenant makeup. As of their last quarterly earnings release, and I know the numbers have changed because you guys have done a couple of acquisitions since then, 55 properties, 4.9 million square feet, a bunch of land, 31 properties in Texas, 24 in Arizona, high traffic locations, high density, high net worth in the backyards of their properties. 1,456 tenants. The largest tenants, only 2.2% of their revenue, so very, very, very diversified. Lease terms range to anywhere from less than a year to over 15 years. And it looks like it's almost like a net lease type situation where the tenant's responsible for a lot of the expense side of the equation and you guys collect the rent. So maybe let's start digging into this, Christine. What is that? You have this, by the way, a lot of this information is from your investor presentation that you guys just published not too long ago. So very timely information here. But from a very high level, what is the sweet sauce of Whitestone? What makes it work?
Well, thank you for asking. It's a pleasure to be here today. I'd say that one of the important factors that we positioned with the company early on, and I'd say we've been around since 2006 and co-founding the company, that there was a focus at the time in retail in particular, that retail was all about the mall in big box spaces. And we saw this opportunity that was being overlooked. And in particular, it was being seen in what I would consider the wrong frame of, as an investment framework. And that is centers that were more local. They were neighborhood centers. They had smaller format spaces. And in many cases, people thought of them as being a high-risk investment proposition. And I'd have to say, I've always been studying this for quite some time and have been in the space since, I hate to say this, in the mid-90s. But there was always this value proposition that was considered high risk. And I looked at it a different way and studied it and said, there's actually value in dispersion and beauty in small. And that is, if there is a concentration of risk, I saw it in the mall portfolio in the power centers. And much of that had to do with just the matter of convenience and time. And then along, of course, came Amazon. And Amazon just was much more of a fix towards people's need for convenience and managing their time. And being local, being sourced right in a local neighborhood, your corner neighborhood center, was a much better place to be as far as meeting the needs of the community from several points of view. Number one, people were able to buy soft goods and goods online. So at that point, that became much more convenient to go through Amazon. In our case, again, we pivoted towards services and most namely food. And that was much more about being closer to the community, bringing the community together at our centers. And then in addition to that, we looked at expanding into other services, really at a point in time where services were also becoming a bigger part of our economy. So I like to say we're Amazon compatible. in the sense of how we focus on who the right tenants are for our space, and also we community anchor. So again, that takes us closer to what type of communities we look for. And in addition to the type of format centers, which at that point in time, again, people saw at risk, so we were able to buy more of those at a greater spread. And for an opportunity and being an opportunistic market, you also want to go where there are areas of growth and business-friendly markets. So that lent us to really starting in Texas first, and then moving over to Arizona, and we went into those top markets, and then as well as focused on the best areas in that market for the highest household incomes. Then taking that a step further, what drives those household incomes? So much of our study went into job growth, where we were on the path of vehicles per day, such as like a school, where we'd constantly be in a location where it was very convenient for the parent. Along with that, we were looking at university systems to see what type of quality education was being provided for a quality workforce for that job growth. So things like that became our cornerstone of our business early on, and they are still what I would consider the pillars of what we do today.
Can you take a step back? We hear a bunch of words thrown around in the world of shopping center REITs, such as you mentioned power centers, grocery anchored centers, community centers, open air lifestyle, enclosed. For the person that doesn't know jack about shopping centers, when they drive by and they see HEB as a tenant, and they think that maybe HEB owns that parcel or owns that shopping center, can you maybe break down what is the difference between, let's say, a power center versus a grocery anchored versus a neighborhood or community center?
Sure. I think the best way to think about this is also the type of center. So that when you mention this, I always think of the malls as being the very larger malls, usually around 500,000 to 2 million square feet. And they happen to be much more of a destination. So somebody will go visit a mall, and they'll drive maybe 20, 30 minutes to go to a mall, but they will go to a mall less often just because it's a destination. And then when I think on the opposite end, our side leans into more convenience. So we'd be catering. So a mall may, again, cater to, a 30-mile radius, where we look for neighborhoods within a 3-mile radius. So much of our focus is in those areas where it's much more convenient. It'll be on the best corner, where the traffic patterns lend to going to work or coming back home from work, or going to school or coming back home from school. And we would be a place that one of the things that we look for is just how often do our clients come, to our customers come to see our clients in our centers. And that would be 1 to 2, sometimes 3 or 4 times a week, versus you may go to a mall once a month. So we're on the much more convenient, much more trafficked in the sense of daily visitations, versus a mall space will be, more of a destination and a larger center. And then so generally you have malls to power centers, then to neighborhood, to community centers, to really what may be your small local strip centers, which may be only 3 or 4 stores.
Okay, very helpful. So you have this great slide in your deck that basically, let's say, highlights 24 and sets the stage for what we're seeing here in 25 so far, and what you call is your growth differentiators, which again, I think is a great slide. Again, for the person that's watching this, what are the key takeaways that they need to look at on this presentation here?
But I think, again, when we talk about small spaces, we look at what the drivers are behind that opportunity for those small spaces. And much of that has to do with the opportunity with our same store NOI, which our same store NOI growth is at the top of the industry. And why is that? Well, smaller spaces, for number one, are easier to fill. And in most cases, they have the widest range. So when I think about a small space size, it's around 2,500 square feet. And you have the widest range of uses to fill that space. And so that gives us a greater opportunity, what I would consider more opportunities to fill that quicker and easier than a larger space, which may be very deep, very boxy. You have to divide. There's only a few types of tenants. They may take a deep space or a big space. And again, that's about 50,000 square feet. So if you drive around your neighborhoods and you see a big, deep box that's been recently vacated, you may only have 20 tenants that you could fit in that type of space. And then if you look at the neighborhood, it may come down to only 2 or 3 that would even choose that location. On our side, we may have a plethora of 200 different types of tenants, and also the type of location it is. We have more opportunistic, locations to open that door to not only a different tenant type, but tenants that are looking to get into our neighborhoods. So that gives us an opportunity, number one, to fill space much more quickly and easier to meet our community needs. And it also costs us less to do so. Now, with that, there's also a conversation in many cases where, well, those type of tenants may not have the same credit. Well, I don't believe that's necessarily true. I do believe that you have to underwrite appropriately towards the right credit towards that space. So we're always looking for the top operators to produce that right value for us for that neighborhood. So again, the top neighborhood, if we're in one of the top neighborhoods in the area, we also get to target those that are looking for those high demographics with that growth. And that gives us an opportunity of a broad range of very successful businesses to choose from. So that, again, what does it help produce that type of growth that's different than others in the industry? And there's one more thing to it as well. And that is we have shorter lease terms. Now, that used to be against, people always saw that as a risk because there was a higher degree of turns. Well, most of our clients, when we have them at our centers, they stay for 10 to 20 years. So we don't have the same kind of turn people think you have. But what I do have is a lease term that's shorter, so I can adjust to the market conditions and the upside of those markets much faster, which means I can also drive those returns much faster as well. So I'd say that's one of the biggest things that we have, that is a big differentiator compared to others in our industry. I would also say that what's really been important with this is that in the last couple of years, we've really improved our dividend growth as well. And we continue to do that and match that going forward into the future. So it's not just looking at how we can drive that same store NOI growth, but that dividend as well.
Talk about, I know we briefly talked about this, basically some of like the tenant sweet spot makeup here, looking at across your portfolio, this great slide looking at base rent across your different sectors. You cite some Green Street data going back a few months ago, looking at your shop space versus anchor space and street versus peers. Maybe again, for the average person watching this, what can they take away here?
But I think, again, another important piece of this is that if you look at some of the stability in our portfolio does come, of course, from our grocers, but also how did we diverse that risk through the portfolio away from areas that are subject to competition, online competition. So again, we leaned into services. We leaned into anything that had to do with food. So if you think about what's competition for grocers, it's actually restaurants. So restaurants also pay a higher rent than grocers. So we get that upside as well from additional food uses that we see as being beneficial. One area and category that we've really seen grow a lot and we've leaned into, particularly because it produces a very sticky customer, is fitness. Fitness is becoming a greater component of people's daily lives, and we also see that as a way of having people consistently come back to our center. So it used to be you would go to a grocery store several times a week. Now it's more like once a week. However, people will go to their local fitness, depending on what your interests are. But if you have a gym in your center, and EOS is one of our favorite tenants that we have in the space, we're finding that their customers come back several times a week. So we get that customer automatically to our center, sometimes 2, 3, 4 times a week. So we like that as bringing customer stickiness as a really important component. And then along with that, we're finding too that it's very, very important to mix in, health, the rest of health, wellness, and beauty, and things like UPS stores and, certain types of logistics that really mix in. And probably one area that we're seeing growing quite a bit, again, is education and also entertainment, or edutainment, as people are starting to call it as well. That's another growing component. Again, all these are about, bringing people together, having a place that you would call, in some ways, your dining room and your living room and also your workout room. We are that extension of that for a community. And what we look for is how do we improve our customer, what I really consider, meeting our customers' needs, being that neighborhood. How do we serve them, right? How do we have them keep coming to our centers? And the way we do that is the businesses we select. So this is where we found to be a very successful merchandising mix for what we do at our centers.
One that jumps out to me, and I get to deal with it tomorrow on the holiday, lucky me, is pets. You talk about stickiness and how
Very
important
sticky.
my vet is right down the street from my house. And that tenant has been in place at that shopping center for over 40 years.
Mhm.
So I understand stickiness because I can't imagine what would happen to the neighborhood if that vet goes away right across the street here. So I get it. All right.
Yeah.
So let's go a little bit more into the strategy. And as we start talking about this stuff, I want to pull up the press release from yesterday. We can look at a quick timeline of the history of REITs if you'd like to see that. Yesterday, you guys announced this massive transaction in Fort Worth, acquiring 5,000 South Hewlin. Respectfully, I am not familiar with the property because Fort Worth's on the other side of town, 45 minutes from where I'm sitting right now. But reading the press release, reading your quote, reading the tenant makeup mix that I'm highlighting here on the screen, Sephora, Navy, Barnes and Noble's, Potbelly, Sport Clip, Kincaid's Hamburgers, good stuff, by the way, and Jamba Juice. Why don't we use Hewlin as kind of the reference point for the next set of these slides as we're going through with strategy and redevelopment, if that's okay. So,
Sure, by all means.
how do you drive value to your shareholders?
So I think and this is a center that you'd say is slightly different than some of our other centers. However, we do have some centers that do have some national makeup and mix of tenant base, and also some have a little bit bigger boxes, but by and large, that's a little bit different. But what we wanted to do here, and where we saw this opportunity in particular, is it comes down to real estate is all about location. And we love this neighborhood. We had been looking to expand from Dallas into Fort Worth for quite some time. We saw that in particular, the neighborhood. So one of the things that we look for is that we look for a neighborhood that has some characteristics of upside growth. And in this, we use Esri. We've been using Esri since the beginning. Esri is a mapping GIS system where you can get a graphical interface to understand who these communities are and how they operate, what their aspirations are, and what their alignment is toward their investment into the future. And what we found here is this was an older neighborhood that was turning. And in that turn, we were seeing that younger families were picking what were great, great home sites, great area for access to work and to really strong job growth. And with that spend, we saw that this is probably an area that was regentrifying. This happens to be across from an older mall. Malls have actually gone through an interesting transition. Thinking about in the 80s, I think there were 2,000 malls. Maybe now there's only 700 of them. And with that, you think about malls are actually also being redeveloped into some open air concepts. So we see, first of all, why we bought this center, really great neighborhood, growth dynamics that we look for, the ability where we can to re-merchandise as well. So with this center, we see the opportunity that not only there's some really good tenants that drive traffic, by the way, two of them in particular I'll talk about in a moment, but along with that, the opportunity to also re-merchandise as this neighborhood shifts and changes. And also because of the location, what is the direction of the mall, right? I think at some point in time, because that land is so valuable, that it will be partially redeveloped. And I think this area itself will be kind of its own little mini town center. That being said, the type of tenants that we liked in there, we do have a few Sephora. Sephora is it's part of, of course, the Louis Vuitton Moët Hennessy line, where you couldn't get better credit than that. And there's just a repeat customer, younger customer that's continually coming into Sephora for a small spend on an item like makeup. That being said, You also have, and this is a little different, is Barnes and Noble, which, by the way, as a brand, and we have another location, it's an open air center, it's a Barnes and Noble. And they have really turned into also what I would consider a community connection. That's where people get their coffee at this location. It's one of the best performers in the portfolio. And that brand has remade itself back. There's a wonderful CEO that I've seen. I've been to his bookstores, Daunt's, in London, and it's creating again a sense of community in that center. And as time goes along, we will be able to improve some of the rents by re-merchandising on this location just because of the growth of the market. So it was a really good opportunity to buy for us. And it was very much an infill property, so there's not a lot of land around it that would be developed into competition either. So that's the other thing that we look at, is an infill location where there's not a lot of competition, but also as I see the neighborhood shift and change, we are positioned as an opportunity for us to re-merchandise for that as well.
So with what you're saying, that's how you could drive long-term shareholder value, because you're able to push up rents,
Correct.
re-merchandise, leads to higher return, higher FFO on the property at the end of the day. Is that correct?
That's correct. Thank you for making short work out of that. But yes, and I would say that redevelopment, as you talked about, and we can go into that in some of our centers, is also a very active way. So whenever we buy a center, the first opportunity we look for again is, what is the neighborhood growth so that we can grow those rents? Can we re-merchandise that to better meet closer to the needs? And then in addition to that, is there any redevelopment work or additional development that we can do as well in that location?
We do have a couple of slides on that ahead, but you look at keys to NOI growth. I think that's a very important driver here. Is NOI growth translates into FFO growth, which hopefully translates into dividend growth. And you have these keys here: rent escalators, new lease rates, improving lease rates, redevelopment lease rates. All of those push down towards a 3 to 5% NOI growth. You also highlight here what drives, or what's been driving that NOI growth, looking at your leasing activity over time here. I believe you and I discussed this slide here, looking at how the past is kind of able to help push towards the future, if I'm understanding this correctly, and that you guys are kind of looking at this 3 to 5% average long-term NOI growth. Is that correct?
That's correct. And I think one of the things that I've seen change so much in the market conditions is that, another very important factor, especially in our markets, it is getting much more expensive to build a new center. And there's not a lot of them being built. Plus, really for the last 10 years, there hasn't been a lot of retail being built either, because there was such an oversupply of retail for so long. So that being said, the opportunity that we've also found is inner centers and new centers that we buy, that this re-merchandising is even more important than ever. So if there's an existing business in the center that's really not performing the way they should for the neighborhood, we are actively taking back that space. The reason being is because I can remarket it now with a much stronger rent than I've been able to do in the past, and with a better quality for that tenant. So I'd say what I look at as a quality of revenue that we've been really improving over the last, in particular, 3 years. And focusing on that effort is, if there's a space available, I'd rather take that space in a strong market now, find a really strong operator that's able to grow and serve that community, than have a weaker operator. And if the economy weakens, then it's too late to replace that tenant. So we've been actively re-merchandising this portfolio over the last couple of years too, to keep improving that rents, and we will continue to do so.
Maybe this is more of a redevelopment question than a re-merchandising question, so I don't need to jump ahead too far. But you got my hamster wheel spinning, and I think about, let's say, an older property with a ginormous parking lot that's misused. Are you guys finding development slash redevelopment opportunities on some of these out parcels of a parking lot that's not being used necessarily, to potentially drive more traffic towards it?
Yes, I think there's two places along the lines when we think about redevelopment. Truly, in the past, centers were created with just vast, and I think a lot of this had to do with the cities and what the development rights were in the past, and that is they were overparked. it was all about adding too much parking. And if you think about it, it really isn't even that attractive to just have this huge span of parking lot. And, 2/3 of the space is, not even used because everyone wants to park up close and up front. And then you have, up, close to the road, all this available parking that's really not being used. And what we found to be opportunistic for us is then to take that and convert that into additional retail. That has been, in many cases, it's highly profitable as well because you have a number of types of retailers in particular that are looking for being close for that access. And so we always have to work, to really see how we can create some of that out of our existing retail, in particular if it's not being used. And it's highly desirable to build out those are called pads or out parcels. So we've been doing a number of those over the years too, and we'll continue to do that, as well as look for those opportunities and new acquisitions.
So I think we've done a pretty good job talking about accretive acquisitions already to this point, even before we got this slide up and running here, where you talked about job growth, the re-merchandising opportunity, the income, all of this stuff. But everything that you've been saying, even before I got to the slide, reinforces this slide that you're basically talking your book here that this is the core principles that we hold true to drive NOI growth. I think this is also another slide that you and I had discussed leading up to this was talking about CapEx, about how you guys are able to boost returns, frankly, with less CapEx than some of your peers. You want to maybe break this out a little bit for us?
Sure, and a lot of this has to do with, again, if you could see us way over to the right, we spend significantly less in investment in order to turn the space. And that comes down to a couple of factors. Again, the size space being smaller and being much more productive in the sense that it has the widest range of uses and doesn't take as much time to turn, number one. And also, so it requires less time to turn the space for a new tenant. Number two, it requires less investment. And number three, how do you invest appropriately in the space in the first place? So, what I always see is that, an example of this is that usually a restaurant, especially second generation restaurants are extremely valuable. Why? Because the initial investment's already put in. So with that, we try to make sure that if we are going to invest a little bit more in a space than normal, is that we're underwriting appropriately for the future value of that space too, not just for the current tenant going in there, but for whatever reason, if the business model changes, it doesn't work out, that's the appropriate investment for that space, that we're making it the appropriate way, that it could be positioned for another tenant to come. And so those kinds of that discipline and that diligence, making sure that you invest appropriately in the beginning in the space, but also in the follow-up after, that you're not consistently, in what I see is in the re-tenanting, that you can keep putting more money in, and that's a destruction of capital. And that's why I think our discipline to making sure that we do this correctly and keep this minimized is very, very important. As you can see, again, it also helps us drive returns. So very important part of our discipline. I'd bring one more piece into this, and that is, if you have a large, deep space, so if it's, generally speaking, we like centers where the spaces are only 55 to 75 feet deep. And the reason why is because it has more storefront and less bowling alley. The deeper the space is, the bigger it is, the more work that you have to do to retrofit it, carve it up, craft it to the next tenant. So again, the type of space, so it's not just the size of the space, we try to stay away from big, deep spaces. They're very, very difficult to convert. And we do have a few, and I think we've been very successful in converting those over to other types of tenants as well, that we don't have to spend quite nearly as much money as you would have to compared to some of the national tenants.
Well, be hating on the bowling alleys. They're going away. We're losing our bowling alleys. We're halfway through our presentation. We're about halfway through the clock, so I think we're doing pretty good on track. But we briefly talked about your redevelopment strategy, and you talk about some of the projects that are in works here, such as Lion Square, Scottsdale Commons, Terra Vita. Maybe talk about, let's maybe look further down the road. Again, I don't know how much you can disclose here, but do you think that this 1% NOI growth, 20 to 30%, 30 million redevelopment spend, will that continue kind of going down the road here? Or is it too soon to make that call?
Well, I think what's really important again is this comes down to there's not a lot of retail available. There's not a lot of it being built. We happen to like centers that maybe, might be a little older, might be a little tired, but they're in great locations. And these in particular, you have to be really good at this when you're doing these value add type of propositions because they require, number one, you're opening up something that you don't quite know if it's built like they said it was going to be built, or you may not even have the old plans because the center is older. But they also give the greatest opportunity for a return for several reasons. Number one, you keep your in-place cash flow, which I think is important. You're not building a new center that could take 2 years, and then by the time the tenant comes in, you're 3 years in and you don't have any cash flow. We're buying existing centers. We have the existing cash flow in place. And as we do the work, you can then start improving the rents or remerchandising along with, with the value that you're creating. That being said, again, requires and I have a team internally that does this, and it's an impressive team for a couple of reasons. One is they're, just from a background of construction. I have 2 team members that are very good at, they've been in the contracting business for quite a many years. I also have an MBA architect that is also on the team because some of this, when you do this, you have to make decisions really quickly. So you come forward, you do your research and say, what's going to produce growth in this community? You look at the growth in the community, you look at then the competitive positioning with other centers and other locations. And I'll use Lion Square as an example in a moment. And then in addition to that, you look and say, what kind of design and what kind of value can I create to upgrade that center to meet the neighborhood? So the first one I'm going to give the example as the one being presented here is Lion Square. That was one that was owned in our portfolio, but was in an area of town that in particular serves the Asian community. But the center itself was really tired. It was one of our older assets that we had. And we started seeing that the community was really starting to improve as far as the amount of vehicles per day, the consistency of how often the customers came to the location. And then we started to see that this is becoming much more of a destination for the Asian community. This happens to be in Houston, by the way, in the International Management District. And we have in Houston, in our study, what we looked at is that we have half a million people in Asian descent that are in Houston alone. And it's a very diverse community in itself as well. So we thought, in order to serve that community, what is it that we can do with this center? Well, we found out that through Michael Su, who is a well-known architect out of Austin, that he said, and working with him, he said, there's a real young demographic that's looking for a little bit more of a modern, new kind of look to a destination they would like to visit. And the same thing with the type of tenants as well, as we were discovering that the Asian community loves to come out in families, but there is a very young population that likes to come to a destination, find their place to hang out. So we decided to dial into this even much more. We worked with Michael Shu to have a really, dynamic looking center. So we're refacading this currently. But we have the in-place cash flow to keep, so we're not taking down any space. We're keeping that in place. We're refacading it. And they can go relatively quickly too. So to build a new center that could, of this size would at least take 1.5 years. And even the approval processes with a city can even take longer. So that's about 2 years in. In this case, it's an existing center. With careful planning that took really probably the longest period of time was to figure out what was the appropriate design and how to execute on this. But the actual execution of the construction is really only going to take 6 to 8 months. So again, we're able to, do that investment and get that return a lot quicker. These are, again, one of my favorite opportunities for upside in the portfolio. But I would say they take a concentrated effort. You never want to slow down your contractors. That means really good decision making in the field. And we have the team that has produced this over and over already in the portfolio, and will continue to look for these opportunities to come.
So we'll play a little bit of the rapid fire question game, stuff that you get asked or peppered with all the time as we come closer to the close here. But didn't have Fort Worth on the list here because this is newer than when we had our last conversation. Where else could we be thinking about? Like maybe a Salt Lake City, Atlanta, Raleigh? Like what other markets potentially are on the horizon if you want to share anything with us?
Sure. I think, I'd been studying Texas for a long time, really since the late 1990s as an opportunity. And as we were starting to see a turn, Texas had really gotten itself into trouble a long time ago with, trouble in the oil patch, and people remember as being see-through buildings and so on and so forth. But we're really starting to see Texas change quite a bit in the 2000s. And again, we started this in 2006. And, part of that drive, and really that was seeded in the 1990s. So part of that drive that we saw there were a couple of things that we look for in similar communities to invest in the future. Number one, is it a business-friendly community? Tremendously important if you are going to be serving growing businesses, entrepreneurs. You have to have a business-friendly environment. And Texas was clearly becoming that, in particular, late 1990s, early 2000s. That was number one. Really, secondary education. Primary is really important as well. But in particular, we were looking and saying, where was a quality workforce being created? And where was it also a younger workforce as well that could match up to growing businesses and the demands for a growing business? In truly today's world, it's really about the labor force. So we're looking for that as well. So we saw that in Texas, that the schools are very strong. In fact, very few young people leave the state. They, generally speaking, go to the schools in the state, may leave, but they usually come back. And the other thing that we found that was really beneficial too is that it had major cities that were well positioned in the sense of being much more global than I think people thought. We have 30 languages spoken in our company in Houston alone. It's a very global community. So we were looking for where were we seeing those characteristics of growth. With that, of course, it led us to the major cities in Texas. But then we started seeing an opportunity. This is really in around 2010. We started buying in Phoenix, really focusing more on the East Corridor, which is Scottsdale, going all the way down to Gilbert, Chandler, Mesa. And we saw that there was a misunderstanding in pricing in the market that was happening. They were hit in particularly hard during the great financial crisis. So we saw it as an opportunity to buy there. So what we look forward to going forward into the future is states that have similar characteristics. And quite frankly, we're finding a lot of states that are starting to mimic the business conditions of Texas or Tennessee or Florida, and they're recognizing the value of doing that. So we're looking for some of the larger cities in those states. So whenever I think about this, Tennessee has done remarkably well and people are already heading in that direction, but you're starting to see Virginia, in particular, certain aspects of Virginia where you have great schooling, though that's growing fast. Definitely in the Carolinas, both Carolinas, you're seeing that, of course. Georgia and Atlanta, Georgia is considered a great hub. And also, what do we look for? We need a great hub. We need, of course, the access to the airport and cheap flights. So things like that we're starting to see. And we're starting to see that flow into other states. Kentucky is an interesting state to watch, as are Alabama and others. So, I think just for us, I can't say where we're investing next, but I can tell you why we would invest in a location. And all those areas are starting to grow in a very interesting direction.
So for those that are
And
watching
cost of
this,
living. Cost of
if
living
those
too,
watching this,
right?
if you have shopping centers for sale in Kentucky, Florida,
Yeah.
North Carolina, Virginia, Georgia, Tennessee,
Mhm.
reach out to Christine at Whitestone. She'd
Thank
probably
you.
like to talk to you. It has to fit all the metrics, though. All right, tariffs. Are you guys impacted by tariffs?
Well, we don't really have a lot of goods, so we're not as greatly impacted by tariffs as what would we consider other spaces in the center, right? So
Well, wait, let me push
yeah,
back on you. Let me push
yeah.
back. Lion Street. You talk about this being an Asian influenced community. So again, if there's an Asian grocery store there that's importing goods from Asia, those might be subjected to tariffs, correct? So maybe reference that at the tenant level versus at the company level.
Yeah, so I think this is really helpful to talk about, right? Is that one of the things that I've seen in particular, and I would say even now, but let's go back to COVID. Um, a lot of this was even happening prior with with this administration that's in place now with COVID. Prior to COVID, you were already seeing tariffs then, and you had a huge supply disruption and dynamic that happened at that point in time during COVID as well. So one of the things that I'm seeing with our clients is how quickly they're repositioning for change and disruption in their supply chain. So I was just at the market actually because I had to visit the redevelopment in place. That is a very healthy, well-stocked grocery store. I didn't have a chance to talk to the owner at that point in time, but I did not see any space open on the shelves. I do think that again, if you have a long lead time in a product, that's where you're going to see most of the disruption. Obviously, automotive is an easy one. We don't serve that area of the business. Furniture can play in there as well. In food, we saw, the most interesting thing was the disruption in the cost of eggs. A couple of what I would say is maybe 2 months ago, maybe it was 3 months ago now, but just how quickly as a representational influence, how quickly our restaurants reposition just around the prices of eggs, right? Whether they added an extra dollar to the menu for an item of the egg in it, or they had started shifting into different types of products. So we haven't seen that much of the disruption, but every once in a while we hear about some surprises as where it is disrupting, but it hasn't had an effect on it. It really hasn't had an effect on our businesses from what we've been able to see. Could it?
Okay.
There's always that. But I just see that most of them have been able to really be quickly, and they're able to move quickly to do it, which is another reason why we like a diversified and dispersed tenant base to protect against these kind of things.
I know we've already talked about active development versus redevelopment. Again, kind of looking at the crystal ball, do you think the puck is going to go more towards the redevelopment side since we're not seeing a lot of active development? If things normalize, do you see active development picking up in full steam ahead again? What's your full outlook here, let's say, on that front?
Yeah, it's been interesting talking to others in the space. Again, if you consider how big the real estate world is, it's actually a small world where we all work together. And we've all talked about this, saying there is a need for more product. The difficulty in product has been really more to do with the challenge of bringing together the financing and then also bringing together the tenant's expectations. And the gap in time that's most difficult to manage is actually the cities and working through the permit processes to be able to develop plus the cost, right? So there's this difficulty of this gap in time, this fluidity and cost that's happening right now that make it difficult to develop. There is a potential that might shift a little bit next year. But again, by the time you get ready to put a shovel in the ground next year, you're talking 2 to 3 years out, by the time you can get that product in place. So I think you're going to continue to see, more focus on the opportunity with redevelopment in existing centers, just because, the metrics prove out. That being said, I think we're all looking forward into the future where we can do some new development. And, it takes, when you think about what it takes to actually develop a center, it's a lot of the planning time is the most important part. So, we're looking as well as others as to saying where in our center can we do some development or new development on those. And we're laying out the plans for that in case there's that opportunity to strike fast and strike quick to be able to get a shovel in the ground.
Favorite topic that you and I love to talk about is the old dividend.
Yeah.
Remember at Hoya Capital, we obviously have our funds. We focus on the income side of the equation. So let's talk about dividend coverage, the safety, and more importantly, keys to dividend growth. I know we've addressed some of it previously, but again, maybe kind of recapping to where we are right now, let's highlight the dividend.
Yeah, I think one of the most important changes really, now I think about this as well, prior to COVID's time, we really had what I would consider not the healthiest dividend coverage ratio. And when COVID hit, nobody knew what the direction of what the future would be at that point. And I think it was important that we did take the drastic steps to right size our dividend and be much more conservative as to how we managed our dividend coverage going forward into the future. That being said, in addition to our dividend, I think we can also talk about debt here, right? So we've in particular also been taking an active stance towards reducing our debt. So we do produce quite a decent amount of healthy cash flow that goes in several places. Of course, our dividend being one of them. The ability to reinvest in our properties for redevelopment opportunities is another, for growth and future growth. And the other is also to pay our debt down. And I would say we have really done a great job with that in the last couple of years, and have rebalanced with the portfolio to make sure that we have safely put ourselves in a good position to grow for the future. And in addition to that, the last couple of years we've been raising our dividend in accordance also with which you would consider that key to the dividend growth, and that's been a consistent improvement in our same store NOI and our inputs into NOI. So I think, whenever we think about dividend growth, the first thing I always think about is, how do I best, first of all, deploy my capital well, right? To have a good, strong capital structure, to maintain a certain level of safety going forward in the future in case there's some kind of shock to the system. Number one. Number two, also to keep investing in our properties appropriately so I can continue that growth in my net operating income, so I can then produce a healthy dividend growth as well, and a consistent dividend growth.
And there's no wall of debt that's coming due. As you mentioned, since you're paying down debt, you're not going to wake up tomorrow and be like, oh, shoot, I've got to pay $500 million in debt next week. I'm screwed.
Yeah, we've been very good at actively managing and laddering out our debt as well. So, and also we look and say, one of the most important things you have is with the relationships with your lenders. But in addition to that, making sure that you have your banks that you have built your relationships with, you've diversified also your debt base as well. And then, quite frankly, always stay in communication with them too, right? So they know they don't have anything to worry about. I remember during COVID hearing from our lenders often, and as they got comfortable with how we were. So one of the things I'd like to say is during COVID, we had one of the highest, we didn't have that many failures within the portfolio. In fact, we really used that opportunity to strengthen the portfolio, number one. Number two, also during that time, we had the highest level of collections in the industry, even compared to the big guys. Our collections were much higher, and we had actually pulled out of the trouble much quicker too. And we were at really 100% collections. I think we deferred very few tenants at that point. Most of them were, our key was making sure that they could operate healthy and during a time of struggle. So we made sure we worked with them on making sure their stores were open, whether it was PPP at that point, a number of things. And because there was so much customer switching from national brands that weren't staying open, they actually saw that as a good time to get new customers. So with that, during that time, we maintained our conversations with our banks, just to tell them what we were doing and why, and to show what the value was with what we were doing. And I think that strengthened the relationship to today. We're now really well more diversified in our debt base and have laddered it out. So it's been a good time for us.
We've talked about experiential offerings. I can recall 2+ years ago talking about pickleball with you, or MMA and UFC gyms and stuff like that, since you are a recognized UFC MMA badass back in the day.
I don't fight anymore in the ring. So that's
if you're looking for a fight, she is not the person you want to mess with. Talk about some of your more experiential type offerings. Yeah. Talk about some more of your experiential type offerings. I know pickleball you got very excited about this, and I know it's paid off in spades for you. What other experiential offerings are you really excited about, or you see coming down the pipe?
Oh, this is a fun one. I really enjoy talking about this one because it lends to how we underwrite for our properties and how our team, our leasing team is looking for new concepts and opportunities. And I would say this probably happened, I have to remember, I think this is it was in 2023. And it was one of our, again, we don't have that many box tenants, but in this case, it was a Trader Joe's anchored center. And there was a Bed Bath & Beyond space, and Bed Bath & Beyond, we could see that it was struggling. It was really hard to tell. By the way, they were greatly impacted by the supply chain, and we started watching their shelves. We saw that the shelves were getting pretty thin with product. We said, you know, I don't think this is going to work out, guys. We need to start looking at a new client that we can fill the space. So even before they were really considered in deep trouble, we were already watching the shelves and saying, I think we got to be prepared for a new kind of client there. So the team went looking, and there were sort of the usual type of tenants that were looking at the space because it was a desirable neighborhood. And they were nationals that I would say they weren't that interesting in the sense of how I thought they would meet the neighborhood needs. They were also the kind of clients that were looking for a lot of money to turn the box, a lot of time to do it. Were very restrictive in their covenants as to what we could do with the rest of the center. And I thought, you know what? You're not really driving a lot of traffic to my center. You're kind of drafting off of it. So I'm not so sure that these kind of clients would be the best for this location. And I said, go take a look again at the neighborhood, see how it's changing, and see if there's another opportunity here. Well, we knew that fitness would fit because it was an active community. It was a young community, it was a very fit community. But fitness, you have to be very careful when you have a Trader Joe's parking lot. It's very busy. So you have to match that up with a user that wouldn't take up too much of the parking and conflict with the traffic with a Trader Joe's. So it kind of was looking for a little bit of a needle in the haystack. Well, crediting one of the team members who went to take a look at this, came back and said, his name is Chris, and as Chris came back, he said, what about pickleball? And I said, pickleball? I said, well, why pickleball? Isn't that played by retirees in the parks? That was my image of pickleball. I'm sorry about saying that, but truly, that's where I'd heard about it most, that, it was an active game that was played mostly in the local parks. Didn't really know too much about it, but had heard that it was a growing sport, but not enough to know how much it was actually growing. So the next step was, well, in order to understand this, and if you're going to underwrite it, first of all, what's the community that they're serving and how do they make money, and how profitable are they? So this is something we always do with any new concept is who's the community serving? Does it match our community? Does it match, also our current base of tenants? Does it fit? Right? I couldn't have something that took up too much parking. In addition to that, we were looking for how profitable it was. Well, after the research, so they went out almost like put together, and they're expected to do this in our leasing committee, but they had put together an entire business case on how profitable pickleball was in the community it was serving. What we learned is that especially during COVID, this was serving a new community, in particular young men. Right? There was some attraction that was bringing young men into the space of being able to meet others. Instead of sitting home and watching TV and drinking a beer, this gave an opportunity to be active in their community. That was their biggest customer base, newest and biggest customer base. After figuring this out, sent the team and said, okay, now find the best operator. And they did. They found that what I think is one of the best in class operators. Again, this is how we like to operate, and that's the Pickler. So they have now opened at one of our centers. They were profitable day one. That was the one in El Dorado. That was in McKinney. That's the north area of Dallas. They are opening now in one of our locations in North Scottsdale. And we'll tell you, we're very, very happy with how the sticky traffic flow they provide, how well they do, and how they bring community together. We see a lot of new concepts that are along the lines of fitness over the last years. The other thing that I'm seeing changing so quickly is definitely anything that has to do with food. People have not stopped eating out. They look for more choices. They look for what's new. They look for what's different. They look for that is a lot of times what brings people consistently back to the center too is your local restaurant. But that's another thing. I see more people eating out of cups and bowls now instead of sitting at, firmly eating off a plate. Sushi, which had its day years ago, is now taking on again the steakhouses, right? Steak is getting a little expensive. People leaning into healthier, more concepts like sushi, Mediterranean food, like kava and kava type, so it's been an interesting space to be in and see that evolve and change.
We talked about what experiential real estate looks like down the road, so we're going to skip over that. I got two more questions for you. So, what keeps you up at night?
Oh, that's always the perennial question. So I think one always, has to be carefully in tune with the economy and to be prepared. One of the things that I do like about real estate is that you can see when things are changing and when they're evolving and when you need to be prepared to batten down the hatches. So I always look and say, is there anything out ahead of the economic curve? Watching tenant sales, making sure that we have profitable operators. If there's a shift or a change in consumer spend, that's probably where I really watch the most, and just make sure that I keep, kind of keep a pulse on what's happening economically and how it will affect our clients and their end users or their customers. The other thing that I think that always keeps me up at night is, I just want to make sure that, as we grow, that we're continuing to, do what we can for our team members. This is the greatest opportunity I have now, is just bringing on new team members, integrating them into our business model. I get to teach as well. It's one of my favorite things to do, and making sure that I provide the opportunities for them for growth. When I see that somebody has learned something new for the day or has taken on something and exceeded extremely well, whether the team or individually has done that, that makes my day. But that's also the thing that keeps me up at night. Am I giving them the opportunities for growth?
Well, we've spent a lot of time over the last hour talking about the keys to the Whitestone success and growth. I want to give you the last parting shot here. Why Whitestone? What's the value proposition in Whitestone for this year and beyond to somebody who is not familiar with the company or maybe interested in buying the stock?
Well, I think first of all, we're in markets of high growth. So real estate is still location driven. We're in the areas of high growth communities where the incomes are higher. We're in those communities themselves. As the incomes grow, they're not tapped out. They're not necessarily retirement communities. They're communities of growth. And I think in our business, in particular in real estate, you have to lean into growth, number one. I like to say that we're in areas that are not constrained supply, we're unconstrained demand. That's always been an important part of our pillar and what we do. So that's number one. Number two, I think that, with us, we are a little bit of a smaller company, which also gives you more upside. We're nimble and quick. We're able to react appropriately in the markets where there are opportunities again for growth. We know them well. We're good sharpshooters. We have a business model that has been perfected in retail since 2006. So this model is not new for what we've been doing. Others are now catching on to it and starting to duplicate it. I'd like to say that we were the first ones really into the community center space. We know it well, and we also know how to execute it, which I believe is shown in the returns over the last couple of years in particular, especially if you look since 2022, when I was able to come into this leadership position. I was so excited to see that we had a great team to drive the value to do this, and we have been executing very, very well. So again, great areas in the market, the right type of shop space for with retail conditions, not enough supply out there as well. So that's for the macroeconomic climate in the real estate space. And then we have a really great team that executes well, and we continue to train that group. They're a young group. They're very, very smart, very quick, and very fast. And I think you're going to continue to see these kind of returns because they're driven by the right people in the team. Value proposition, keep looking at earnings, keep watching us, folks. Ticker WSR.
Thank you so much for spending the last hour with us and educating our audience about Whitestone. I can't thank you enough. I really value our relationship that we've had for many, many years. And I know that many folks are going to keep an eye on watching this story continue to evolve as you guys focus on the properties in your backyards.
Oh, thank you so much once again for this opportunity. Good to see you again as well.
Thanks, Christine. Talk to you soon.
Thank you.
Bye-bye.